Hi everyone, this is Mrs. V Chen. Welcome to my Form 5 Accounting lesson number 10. And today is 8th of March 2020. So we will do this DSE question in 2013. And this time it is a combination of both admission and retirements. Okay, now let's take a look at this question in 2013. So we have this. Carrie and Daisy have been in partnership, all right? And then on 1st January, Carrie retired from the partnership. That means Carrie is leaving the firm. And then Ellen was admitted. So this is the combination of both admission and retirements. Okay, now let's take a look at the diagram here. So the old partners are Carrie, Daisy. Now the new partnership, we have Daisy and Ellen. And the dates here is very important. So on 1st of January. So how many things are there we have to do when we combine admission and retirements? So therefore, number one, we have admission of Ellen. Therefore, who has to bring money into the partnership? Of course, the new partner. The new partner is Ellen. So that we have capital introduced by Ellen. All right. And then since the profit and loss ratio not the same as before, okay, so the old ratio is 3:2. Okay, so what about the new ratio? Let me find the new ratio. Okay, the balance of the partnership, where's the new ratio? Okay, equally. So 1:1, it doesn't matter. So therefore, since the profit and loss ratio not the same, so as before, same as before, we do Goodwill adjustments, we do revaluation of assets, and finally, okay, who's leaving? Carrie is leaving, so that we need to close everything related to Carrie. So this is about the combination of both admission and retirement. Okay, so let's take a look at point A. So what things we have to do? So point A, we need to draw up partners capital account. Look at the dates. So 1st January. And right after that, we need to prepare statement of financial position. The same dates. So since Carrie is leaving the firm, therefore, after retirement of Carrie, so we have admission of Ellen. So this must be the statement of financial position for the new partnership. Okay, and as for C, don't worry about that. So let us finish A and B first, because these two parts, okay, happened on the same date. Okay, so to begin with, I already have the capital accounts with 3 columns. Okay, so the old partners are Carrie and Daisy, and there's no Ellen. All right, so therefore I get this capital account to begin with from here. Okay, so since Carrie is leaving, so all things related to Carrie should be closed to the capital account. And since there is current account as well, all right, and Carrie is leaving, so therefore we have to close current account for Carrie into her capital accounts to close everything related to Carrie, right? So however, this 72,000 is a negative item. So if we close it, we credit current accounts for Carrie, and then we debit capital account for Carrie. So that's why the capital account for Carrie, we put this on the negative side, which is the debit side with current account, but not Daisy, because we have to keep current account for Daisy since Daisy is still here as one of the partners. All right, okay, and after that, so this is part B, statement of financial position for the new partnership. They are Daisy, Ellen. Therefore, look at the capital account here. Daisy, Ellen, and who's not there? Carrie is not there anymore. Okay, next, let us go through this point step by step. Number 1, Ellen brought in this much. So who is Ellen? The new partner. So this is related to capital introduced. So the double entry is debit cash and credit capital, and which is Ellen to begin with. So 850,000, 850,000. Okay, so debit cash, so that I have to go to statement of financial position. So what is cash? So which will be current assets. So if you remember the order for current assets, we always have what? We always have inventory, the closing one. We always have trade receivable as usual. Okay, now we come to cash. All right, so since this is a lot amount of cash, so very often we will put this in the cash at bank accounts. So otherwise it does not make any sense. We won't put this much of cash, right? So cash at bank. So to begin with, I have 100,000. So here, cash at bank. Okay, so to start with 100,000 plus, okay, the amounts brought by the new partner, which is Ellen. Okay, you can see I just do double entry. So debit cash or cash at bank, and then credit capital Ellen. So I go to here Ellen, so 850,000, and then this is cash. Okay, so point number 2, we have balance of Carrie's current account was to be transferred to her capital account. So here, this is the current account. However, it is a negative. So actually, we have done this already. We already have recorded this at the very beginning. All right, so to close current account into capital account. So remember, even though you don't have this point given to you, you have to do that always to close all the current account into capital account whenever you have retirements of an existing partner. All right. Okay, next point number 3. Property was to be revalued at this much, and the net book value of equipment was to be decreased by. So this is related to revaluation accounts. So if you look at the requirement here, which is not mentioned, so therefore we need workings here. This is our workings to show revaluation, to do it step by step in order to work out whether we have gain or loss on revaluation. Okay, so let's look at point number 3. So property was revalued at this much. We need to compare property. This is the old value, and this is the new value. That means we have to increase property by credits here, revaluation account, because of property. Okay, so how much is the change? The change will be the new value, which is 2,320,000 minus the old value. The old value for property is 1,250,000. Okay, my calculator is here. 232 million minus 1,200,000. So I have this 1,070,000. Okay, so follow double entry. Therefore, in the statement of financial position, property is a kind of non-current assets. Okay, on the same dates, I put property here. So after the double entry, the value for property will change to the new value, which is 2,320,000. Okay, all right, so next, after property, so there is equipment. However, equipment decreased by, that means, decreased by 20%. Okay, that means equipment, this 600 is too large. We need to decrease it, and this is a bad thing. Okay, so what I said, I go to another side here to decrease this by debit revaluation because of equipment. Okay, and the change is, so how much is original? 600,000. Okay, so the change is 20%. So I have 600,000 times 0.2. Okay, so this is the change. So that how much left in the statement of financial position after I have decreased equipment. So 600,000. Okay, after deducting 20%, I have 80% left. So that will be 600. Okay, sorry, 6 times 0.8. So therefore, this is 480,000. So we just do revaluation step by step. Okay, so next we have interest on capital. So be very careful about this point. Since we are doing part A and part B, so what do we have in part A and part B? Let's look at the timeline again. So where is my timeline? So my timeline is here. So part A and part B, what is our concern? Our concern is about the adjustment for admission and retirement. We only have these 4 things. So therefore, this point, about interest on capital actually has no effect at this moment. Okay, but it will have effects later on when we move on to part C, which is at the end when we come to 31st December 2012. So at this moment, we don't need to do anything. Okay, and finally, this is the new ratio. All right, so therefore, we have finished all the adjustments about revaluation and goodwill adjustment. Now actually we can close the capital accounts. Okay, so next I can close my revaluation accounts and realize that the credit side is bigger than debit side, and credit side always positive and this is negative. So therefore we have gain on revaluation, and then we use capital account for the adjustments. Okay, now here something important. So who's going to share the gain on revaluation? It must be always the old partners. So that would be Carrie and Stacy. So using their old ratio, so 3/5 and 2/5. So this is important that I need to remind you who's going to share this gain or loss. It must be the old partners. Okay, so remember that this is important. Okay, so I use calculator divided by 5 times 3, so 556,800 goes to Carrie, and the remaining, okay, 371,200. Okay, and this is gain. Gain is a good thing to partners, and the old partners are Carrie and Daisy. So credit 556,800, 371,200, nothing for the new partner, and this is revaluation. Okay. Okay, now we come to point 5. Point 5 is about a check paid to Carrie, and at this moment you don't need to worry about this point, because to close Carrie's capital accounts we must finish all the adjustment first. So leave that point. So we go to point number 6. Goodwill was to be valued at this much, and this is method B, the second method. No goodwill account was to be maintained. So same as before, we draw up the table to adjust goodwill through capital accounts by debit the gain and credit the loss. Okay, so we have the same table before. So using old ratio, Ellen is not here yet, and using the new ratio, Carrie is leaving, so Carrie is not there, and then we need to work out who gains and who lost. So look at Carrie. So who established goodwill? Remember, always the old partner established. So Carrie should get 210,000, but now Carrie has a loss, which is not fair to her. Okay, and look at Daisy. Daisy should get 140, but now there's a gain for Daisy. So 175,000 minus 140,000. So this is a gain. Okay, and Ellen should get no goodwill, but now she gets 175. So this is a gain to Ellen. So how do we adjust this? Using capital account, we always debit the gain to charge partners who has gain. So capital, that is Daisy, which is 35,000. Okay, to charge again, so debit the gain capital Ellen, right? And then we need to compensate Carrie because Carrie has a loss. So credit capital Carrie and 210,000. Okay, so this is the adjustment for goodwill using method 2, which is no goodwill accounts open. And now I need to post this to my capital accounts. So that big the gain. So that is Daisy has gained, so 35,000, and Ellen has gained because of goodwill, and credit Carrie has loss, and this is goodwill. Okay, so this is about goodwill adjustment. Okay, so point number 4, an allowance for doubtful debts of 4% was to be made. Again, this is not a good thing, so that we put this on debit side of the revaluation accounts, so which is allowance for doubtful debts of 4%. So therefore the 4% on original trade receivable, which is 550. So I have 550 times 0.4. Okay, so here I have 22,000. Okay, and at the same time, I need to adjust my trade receivable. So originally, which is 550,000. Okay, minus 4%. So how much is 4%? 22,000. So this is how we do revaluation step by step, and then minus 5. Yes, so here I have 528,000 for that point. Okay, so the next thing, after all adjustments, we need to close Carrie's account. So therefore we need to go back to point number 5 and saying that a check would be paid to Carrie. That means obviously Carrie has a credit balance, and that's the firm has to pay. And then here, the remaining balance owed will be left. That means the amount we pay is not enough to cover the credit balance. But anyway, this is the calculation. So here, let us close Carrie's account in this way. So Carrie, okay, credit side is larger, so that is a credit balance, and bank, that is amount we have to pay. Right, and this will be the balancing figure if you use your calculator. So that will be 1,164,800. Okay, and this loan from Carrie will be balancing figure. Okay, in the capital account. So, and which is non-current liability. So I need to go to my statement of financial position. Okay, so here I have non-current liabilities, and that is loan from Carrie, and which is the balancing figure in the capital column in Carrie's capital accounts. Okay, and also I need to minus the amount we pay to Carrie. Okay, so this is it. Okay, and then for the other two partners, we have Daisy. You just close it as usual, so that you use your calculator, and then you get the balance carried down as this much. Okay, and then you do the same thing to Ellen. Ellen also, okay, has a credit balance which is positive. So, and who's not here? So Carrie is not here, so we don't have any closing balance for Carrie, and these two will be in the statement of financial position. So this is my statement of financial position. I have Daisy and Ellen. So how much is Daisy? Daisy gets 986,200, and then I have 675,000 in Alan's account. Okay, so we finished the capital accounts, and now we can finalize everything in statement of financial position. Let's look at the question. So we have done this, right? But now what's left? Don't forget, we still have DSE current account at this moment. There's no adjustment. Don't forget this. All right, so DSE current. So where's my current account? So current, DSE, because on this date we have no adjustment related to current, so which is 247,000. Okay, let's check. Done property, we have done equipment, this one. Okay, trade payable. What is trade payable? Current liability. So I have my current liabilities here, so that is trade payable, and which is 275,000. Okay, so what's left? Cash at bank, we have finished. And bank loan, repayable. Look at the date. So is this more than? Yes, the date is longer than 1 year, so it will be non-current liability bank loan. So finally, I have non-current liability. We have another one, bank loan, which is 700,000. And now I can use calculator to close everything. Okay, so therefore to finalize everything in a statement of financial position, when you use your calculator, so we have this for total assets and there's no inventory. Okay, and we have all this. Okay, the second part, and which are the same. Okay. Okay, so after we have done A and B, now we come to C. So we have this. If net profit for the year, and then now we need to prepare partners' current accounts and look at the date here. It is already 1 year later. So this is the timeline again. So we have done admission and retirement, and then now we come to 1 year later at the end. We need to show the partners' current accounts. So for DSE and Alan and Carrie is no longer there. So here is part C, the current account. So what do we start with? We have nothing so far. For Alan, if you refer to the statement of financial position, we only have the beginning current account for DSE, which is 247. So therefore I have 247 to begin with. All right, and what is important in the current account? So current accounts is always related to the items also in the profit and loss appropriation account. So therefore we must do workings now to show what do we have in the profit and loss appropriation account here. So here is the working for profit and loss appropriation account. So what do we start with? We start with net profit, 300,000 given to us. Okay, so part C. All right, and also we need to take a look at this interest on capital and salary to partners. We need to do it step by step. So here is it. So interest on capital, okay, to be paid by the firm. So that here, so interest on capital to be deducted. So we have DSE and Alan. So 4% given, 4% given. But however, why we have this? Okay, so then this is important. So we get this from the statement of financial position we have prepared just now in part B. Okay, to begin with. Okay, so therefore you have this interests on capital, so debit profit and loss appropriation account, and the partner is going to earn this, so I need to credit this to my current account. So DSE will get 39,448 and 27 for Alan, and this is interest on capital. Okay, and similarly, not only interest on capital, at this point we also have, okay, salary to DSE. Now be careful, this is per month, so you need to times 12 here. So salary in the profit and loss appropriation account to get 1 year salary, so 60,000. So debit profit and loss appropriation account and credit current account for DSE. So here is DSE, so that is 60,000. Okay, and this is salary. Okay, so next, this is our working in the profit and loss appropriation account. This figure is positive, so therefore we have share of profits. So the new partners are DSE and Ellen equally, so 1/2, so therefore this is 173,552. so I need to use my calculator. 173,552 half divided by 2, so each of them will get 86,776, 80,706. Okay, and share profit is good thing to partners. So here is my capital account. I credit 67,776, 86,776, and this is share of profits. Okay, so finally, when you use calculator to close everything for DSE and Ellen, you will get this closing balance for DSE and Ellen. Okay, so therefore, so the final thing to remind you, you can see the functions for current accounts and capital accounts. So what do we put inside the current account? We always have these regular things: interest on capital, salary, and share of profits. But however, what do we have in the capital accounts? We do adjustment for what? We do adjustment for capital, we do adjustment for revaluation of assets, and then we have admission of a new partner. So this is what we do, the things in capital accounts, and the regular things like interest on capital and salary, share of profits, we will do that in the current accounts. Alright, so that's all about this question in 2013. We have admission and retirement happened at the same time. Thank you for watching my video. I'll see you next time. Bye bye.